Welcome to the Plan Solutions Incorporated podcast. We've got some great topics we're going to discuss today. Common sources of negative tax surprise. We're going to touch on 7 factors there where inflation is hiding. We've got 5 interesting areas that you may not be aware of concerning inflation. Also, sale of primary residence. Are you a homeowner looking to sell your personal residence? Well, what do you need to know about Section 121? And of course, we've got with us Mr. Armour, the president of Plan Solutions. How are we, good sir?
Doing well. It's the opening day for March Madness, the big basketball tournament. And even though I don't think I've watched any college basketball this year, somehow it's just an event, right? You have to pay attention.
I know. I had it on my whatever TV plan there. It said, would you like to put on your DVR all the March Madness games? And I was like, yes, I would. So I'm with you. Well, and I'm Jason LaChance. And hey, thank you for listening to the podcast. If this is your first time, hit subscribe on Apple Podcasts, Spotify, whatever platform you're listening on. Also, we are now available on YouTube, and you just need to search Plan Solutions on YouTube and you'll find the channel. Mr. Armour, we've got these great topics we're going to dig into here. So let's start with common sources of negative tax surprises. This was a really interesting read. And you really pinpointed out 7 different factors here. But a lot of people come tax season may not think of some potential negative ramifications from maybe multiple sources of income or whatever it is. We're going to touch on all of that.
Yeah. And I mean, here we are in tax season. So obviously this is top of mind, but really, these different factors, if someone falls into one of these categories, really they just need to be more proactive throughout the year in doing their tax planning, because they fall into a situation that doesn't really fit our tax system. So they're going to end up with some unusual results, sometimes to the positive, but of course, generally what people are worried about is those negative tax surprises when they owe more than expected. So we want people to be aware of those. So, so hopefully they're doing the planning that needs to be done to avoid them.
Yeah, absolutely. Well, this is an area that you've folks at Plan Solutions helped me with. The first thing you point out is when you have multiple sources of income, which is very much me. I'm in that area. So the tax planning around that's been very vital.
Yeah. It's more and more common in today's economy, right? Kind of the old traditional was, you had one employer, they give you a W-2 at the end of the year. And that's what our system is set up for, to, withhold taxes at pretty reasonable rate. And then have that just perpetuate even as the income maybe goes up or goes down from year to year. But when you have multiple sources of income, and especially when it's multiple smaller sources of income, right? So this could be, someone who has, side hustles, right? Where they're doing different contract work, or they work for a couple different employers and they bounce around. Or even you can see it with retirees, where maybe they have Social Security income, a couple small pensions, they take IRA distributions, or even have some part-time work in there. It could add up to, plenty of money to get by from month to month, but each one of those sources being fairly small. And the problem is that the tax withholding that's done at the source of each of those payments, really, they only see that one payment, right? And so they assume if it's a pretty low payment, they think, well, okay, this person's fairly low income. They're going to have deductions. They're going to go into the low tax bracket, and they may withhold very little in tax. But of course, if you add all of those together, you could be in a higher tax bracket, but they're all assuming that you're in a low tax bracket, and you're really double counting the deductions, because each one of those sources is assuming you're going to have the standard deduction, at least, that you're going to be able to offset income. But in the end, you only get to claim that once. You don't get to claim it for each source of income. So it can lead to very little, sometimes even zero tax withholding, when, otherwise you'd expect there to be tax withholding, that maybe zero tax withholding, because you just didn't earn enough to have withholding, but you're actually in a much higher tax bracket than is being assumed by the tax withholding.
And what are some of the ways maybe that can be combated? I mean, getting an overall scope of what your potential annual income will be, and thus through each independent source, if you are a paid employee, that is, and there is withholdings, let each place of that you're generating income through maybe a greater withholding from each source of revenue.
So that's one way to do it. I mean, really, the only way to determine the tax liability or estimate the tax liability is to do a tax projection, to consolidate those different sources of income, figure out what the tax is likely to be based on the best information you have available at the time. And then, yes, you can go back to those employers and have them withhold more. There's different ways to have that done, or potentially make estimated tax payments where you pay in quarterly taxes, based on that amount that you can adjust it as you go. But so you're paying in throughout the year and then don't have this big amount owed at the end of the year. That also can, help to avoid underpayment penalties.
Absolutely. Well, we've talked lately about tax stock-based compensation. Let's touch on that. I mean, that's something that you bring up here as well.
Yeah, this is one that's come back this year. It wasn't such a big problem back in 2022 with the markets having a rough year. But in 2023, the markets bounced back really strong. And so we're seeing a lot of this stock where it's taxed at different times based on the type of tax-based compensation. But the one where I see often a big unexpected issue is with restricted stock. So the way restricted stock works is, someone is given a grant and then they have to work for the company for so long, and then those shares become theirs. That's called vesting. So when those shares vest, they are taxable, right? The way to think of it is it's basically a bonus that you're being paid, but that bonus is in the form of stock rather than cash or, just straight money. And what often fools people is that when that stock vests, it becomes taxable and there's required tax withholding, right? So they see, oh, taxes are being withheld. I must be okay. But what they don't realize is that under federal law, it requires tax withholding of 22%. You can't be higher, can't be lower. Well, it can be higher if your total vested stock is over $1 million. They will withhold it 35%. I haven't seen that situation yet, but maybe there's somebody lucky enough out there. But so they're withholding at 22%, which in some cases works. But someone could be in a 22% bracket, but they also could be in a 24%, 32, 35, 37%. Because again, this compensation is being added on to their normal wages. So it can definitely put them into a much higher tax bracket. And you can imagine if they're withholding 22%, but you're actually in a 37% tax bracket, and this stock-based compensation adds up to a significant sum, you could end up with a really large tax liability. So even though there's taxes withheld, in many cases, it's not enough. And so people need to be thinking about that.
And what's maybe a method to combat that?
Yeah, planning again. When stock vests, I often tell clients, if you have a significant amount of stock vesting and, you see that on your pay stub and you see the tax withholding, give me a call, right? Let's run those numbers. Let's figure out how much was withheld. Let's figure out what tax bracket it's going to put you into. And if there's a shortfall, then we either need to, set money aside to pay the taxes at tax time if you fall into one of the safe harbors where an underpayment penalty will not apply. If you don't fall into a safe harbor, then we probably just want to make a one-time estimated tax payment at that time so that you don't end up paying even more come tax time.
Okay, thank you for the clarification on that. Hey, this is my area. Income not subject to tax withholding. I'm an independent contractor primarily, and that's how I generate my sources. And I really had to get educated on this and what I needed to look at and how much I needed to set aside potentially for taxes.
Yeah, independent contractors that receive Form 1099, there's not tax withholding there like there is on your W-2, right? When you get a paycheck, there's income tax withholding. Not only is there income tax withholding, but there's Social Security and Medicare taxes. And that's another factor that can compound this issue with independent contractors because they have to pay income taxes plus self-employment tax, which is the Social Security and Medicare. And a lot of people don't realize is as a independent contractor, you're both the employer and the employee. So you actually pay double the amount of Social Security and Medicare taxes. You don't have an employer to pay the other half. So it can add up to a significant sum. And, if you have, extra income, from a side hustle or something like that, or, maybe multiple sources, some are W-2, some are 1099. I mean, I see a lot of kind of mix and match these days. You really have to be on top of that 1099 income and make sure that you're making estimated payments to keep up with not just the income tax withholding, but also the self-employment tax that's going to apply on your tax return, which can really cause those percentages to be pretty high, right? I mean, if you're in a 22% tax bracket, I mean, that's already a pretty significant sum federal. But you add in the roughly 15% self-employment tax, you're now at 37%. If you're in a higher tax state like California, that's going to be roughly 10%. So you're already at 47% once you get into that kind of middle tax bracket. That can add up really quick if you bring in additional income via 1099 with no tax withholding. I mean, the tax liability literally could be half or possibly even more if you're in a higher tax bracket.
Yeah, absolutely. Well, hey, here's something that some of us are currently facing or will face as our children get older, a decrease in tax credits. Sometimes people don't think about that either.
Yeah, a lot of times, you'll have your withholding dialed in. You just going from year to year, everything's working out just fine. And then all of a sudden you get to a year where you owe several $1,000s. And one of the causes could be that you were claiming a child tax credit for many years, and then suddenly your dependent aged out of the child tax credit, or they age to the point where it decreases from $2,000 per dependent to $500, right? So still a pretty sizable decrease. So yeah, paying attention to those things and the effect that it may have, and then there's the child care credit. So if someone's paying for child care, their child could age out of that once they're 13 or older. In some cases, they're still claiming summer camps or different things as child care credit. Maybe the kid no longer needs, kind of a full-time, child care, or needs to go to a child care facility, but there may have been other credits that they were claiming under that now they're no longer eligible for. And then higher education can be a big one as well, right? Then once they get into college, especially the first 4 years, where you can claim the American Opportunity Tax Credit, which is a pretty sizable credit. You get that for the first 4 years, and then it drops off. You may be able to claim the lifetime learning credit if they're still in school or maybe going for a master's degree or something like that. But that also can be a pretty big decrease. And those credits, those are dollar for dollar off of your tax liability. So if you lose a $2,000 credit, I mean, that's literally going to result in your tax liability being $2,000 higher. If you already owed, you now owe $2,000 more than what you otherwise would have.
Absolutely. Well, let's talk depreciation schedules. I mean, maybe you're a business owner, investment, real estate. There's some things to know there for sure.
Yeah, depreciation can be a great deduction, and sometimes pretty sizable deductions, right? Where a business owner buys some equipment or some type of asset that they are expensing over several years. Or the big one we see is rental real estate, which is, residential real estate is depreciated over 27 and a half years. So, you bought a rental a long time ago. You've been getting this deduction year after year. It's been sheltering the rental income and saving quite a bit in taxes. And then all of a sudden you get to that year where you're 27 and a half years into it, you have fully depreciated this, and that goes away. And that can lead to a real big jump in tax liability. And it's a tough one to track because you're literally looking back 27 and a half years to remember, well, when did I put that, property into service and start depreciating it? So it is something just to review and be aware of if you've had a rental for a long time, that maybe you're getting towards the end of that depreciable life.
Finally, let's jump into investment capital gains.
Yeah, so that's always been one that can create some variability. Like I said earlier, in 2022 wasn't a real big issue with the stock market being down, but now and with the market being back up in 23, people who are selling and maybe rebalancing their portfolio or things that can definitely result in some gains that can create an unexpected tax liability if they're not tracking it. Or the other thing is a lot of cases pass through investments, whether that's mutual funds or real estate investment trusts, sometimes certain partnerships. These are entities, investment entities that don't pay tax at the entity level. They pass all of the taxes through to the owner. So it shows up on their personal tax return. And, sometimes it's when things are sold inside of that investment vehicle, you may not even see it, but it passes income through to the taxpayer. So, it's usually a good idea, if nothing else, just to be prepared to cover the taxes on those because it can be unexpected or, usually any planning that you can do is usually right towards the end of the year where there's not a lot of time or there may not be anything that you can do at that point to offset it. But just making sure that you have some liquidity and you have some money available to be able to cover those taxes from year to year as they may fluctuate up and down.
All right. Well, let's jump into where inflation is hiding. I mean, you bring up five key areas here. Of course, we've talked a lot about, shelter being one of the biggest factors that we're seeing in inflation, but there's many other areas too that are really hitting people.
Yeah, in this latest report, the headline inflation rate was 3.2%. So it's basically just been really stubborn there in the low 3% range. A lot of same things that we've been seeing. Shelter costs were up 5.7% year over year. Some would argue maybe that's not the most accurate number, so it's created a lot of debate, but it's clearly a big cause. But then in some other areas, we've seen some significant improvement. Food prices were up just 2.2%. So, nearing that Fed target, and most of that was food away from home as opposed to food purchased, for consumption at home was very low inflation. And then actually energy prices, which were kind of the thing that started off this bout of inflation, they were actually down 1.9%. So they were deflationary. So those areas have improved and helped, but there was a number of areas that kind of jumped off the report as standing out. One of the big ones being auto insurance, which was up 20.6% over the past year, which, auto insurance is only 2.8% of the average household spending, but with such a large increase, it contributed 0.6% all by itself to that 3.2% inflation rate. So if we weren't seeing such high auto insurance inflation, we'd have an inflation rate down around 2.5%. And then as we talked about, food inflation. So, food consumed at home only increased 1%. So, really has come down a lot. But food away from home is up 4.5%. And it represents over 5% of household spending. So that alone is 0.25% that it added. And then the last one was the cost of hospital services increased 6.1%. And that's just notable because actually through most of this bout of inflation, medical services, which previously had been one of the few sources of inflation, has really been deflationary. It hasn't increased. We've seen other categories go up, but we've seen medical services in general stay pretty flat. But we may be seeing some change there with the 6.1% increase in hospital services.
Yeah, absolutely. Well, and you also threw in here a couple of other areas too, motor vehicle maintenance being one of them.
Yeah, motor vehicle maintenance up 6.7%. So obviously you combine that with insurance and owning a vehicle is definitely been a source of inflation. And then one that is really a very, very small portion of the index, but is just notable was tobacco and smoking products increased 7.1%. But it's such a small amount of spending, it doesn't really have an impact on the overall inflation rate. Although I guess if you are tobacco or smoke, you're probably definitely feeling that one at 7.1% inflation rate.
Absolutely. And is some of that, as far as you know, when it comes to tobacco products, connected to the raise of the tax on those products?
That's generally what we've seen. Yeah, we've seen high inflation in that area, and a lot of it is because of added taxes, which we've also seen with things like gasoline prices at times, right? Added taxes. So, yeah, the taxes that get collected. I mean, what we're measuring is end prices, what consumers are actually paying. So, most of the time, those taxes are going to be passed on to consumers in the end.
All right, let's jump into sale of primary residence. Section 121. I've never heard of this provision.
And see, that surprised me. This is one of the best provisions in the tax code. For some reason, I've always just felt like it was fairly widely known. And yet, we continue to run into situations where people are just completely unaware of it. And we have to, walk them through the process. But yeah, it's one of the best provisions because it allows an individual to exclude up to $250,000 in gain on the sale of their house. And a married couple can exclude up to $500,000. So in many cases, that's enough to completely wipe out any capital gain that they may have when they sell their house so that it's not a tax issue. You may still have to report it. You may have to show what the house sold for, what your cost basis was, maybe what improvements you've made along the way. Obviously, you get to deduct the expenses from the sale or the purchase. So, you may have to report all of these things to show that in the end, the gain, the difference between what you paid and what you got out, was less than the amount of the exemption. But it's a great tax benefit in that you don't even have to reinvest the money into a new house. You could sell your house and go rent, and married couple can get up to $500,000 tax free.
Yeah, no, it's amazing. So what are the qualifications, though? We talk a lot about exclusions and what criteria people must meet.
Yeah, so to qualify, people must have owned and lived in the home for 2 out of the previous 5 years. If it's in the case of a married couple, or let's say they got married while they were living in the home, but only one spouse owned it, that's fine as long as one of them meets the ownership requirement, but they both have to meet the use requirement to qualify. And then there are a lot of other kind of exceptions and different ways that you can use this rule to still get the benefit, or maybe to get a prorated benefit, depending on the individual situation. So anytime you're in a case where you're selling a primary residence and you're likely to have a gain, it's definitely worth having a discussion with a tax expert. Even if you don't qualify for the 2 out of the last 5 years, there still may be a way that you could qualify to get some benefit.
All right, well, let's jump to the Plan Solutions Incorporated office bulletin board. Got one item pinned up there.
Yeah, this is an important one. Every year we have to remind people that, this year tax returns are due April 15th. But of course, most people know they can file for an extension, which will give them an extra 6 months until October 15th to file their taxes. And if you're not going to be able to get all of your tax information together, or maybe you're waiting on some documents that come out later in the year, then obviously filing an extension makes a lot of sense. But a common misconception is that an extension not only gives you an extension of time to file your return, but also an extension of time to pay any tax that's due. And that is not the case. Any tax due is still due on April 15th, even if the return isn't filed until October. So it's very important that people don't just say, "Oh, I'll go on extension," not even bother collecting documents and set everything aside. It's really important to get as much of the tax return done as you can, and then estimate, those things that maybe you don't have to the best of your ability, to determine that if you have a tax liability. And if you do, you should be submitting a payment when you file for that extension, because otherwise you could end up with late payment penalties, underpayment penalties in the form of interest. Right, it can really add up, especially at today's interest rates. The IRS is charging 8% on any unpaid taxes. So 6 months at 8% on, let's say a sizable tax bill can really add up.
Yeah, absolutely. Well, and my question that this prompts for you is, let's say you file an extension, you make that payment by April 15th, and there's a bit of an overage that you're going to owe a little bit more than was estimated, does that still fall under the area of charging interest for that, or do they look at it? Oh, this documentation came at a later date, so
it would still likely apply, but at least in this case, it would apply on a smaller amount, right? So hopefully you're close enough. It doesn't add up to a whole lot. Hey, you got to keep the money and invested, or earn interest on it over that time period. So at least you're not really going backwards a whole lot. But if there's a potential sizable tax liability that's out there on thousands of dollars, then it definitely adds up. So yeah, you can never really get it perfect. You want to do the best that you can. In some cases, some people may choose to be a little bit cautious and overpay, and then get a refund just to make sure that they don't end up paying. But usually, at least just making sure any of those big liabilities are accounted for is important.
Absolutely. All right. Thank you, Mr. Armour. Anything else you'd like to add before we wrap up this edition of the Plan Solutions Incorporated podcast?
No, just hope everybody's having a nice spring. I know the weather here is really improving. It's nice. I just can't wait till we can get through tax season, can take more advantage of it.
Absolutely. I'm getting out and working on my golf game this weekend, so I'm going to enjoy a little bit of that good weather. Well, we thank you all for listening to the Plan Solutions Incorporated podcast. Again, available on Apple Podcasts, Spotify, now on YouTube if you search Plan Solutions. And if you want to subscribe to the personal financial review that we discuss here on the podcast, send Katie an email there at Plan Solutions. It's KATIE at plansolutions.com.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.